Welcome to How Bonds Work, the Basics. My name is Rodney Constable. I'm the president and founder of Simple Market Signals at simplemarketsignals.com. I am also a former financial advisor and a former vice president and regional sales manager for Oppenheimer Funds, the mutual fund company. Let's start off with bond basics. Bonds are basically loans. That's all they are. And bonds pay semi-annual, of course that means every 6 months, interest payments in the form of what's called yield. And a bond's maturity is the length of the loan. So if you're looking at a 10-year bond or a 15-year bond, 30-year bond, 50, 100-year bond, 2-year bond, whatever it is, that's the bond's maturity. So we're going to take a look here on the next slide at an example of a U.S. 10-year Treasury. But when we say 10 years, that's the maturity. That's the length of the loan. That's the lifetime of that bond. So with the example of a U.S. 10-year Treasury bond, and let's just say that the yield is 2%. I'm going to give you the yield here as of the time that I constructed this presentation, which the yield changes constantly, right? But let's just say for easy math that the yield on the 10-year Treasury is 2%. So here's how this works. You buy a U.S. 10-year Treasury bond for $1,000. Bonds generally trade in increments of $1,000. So let's say you buy a U.S. 10-year Treasury bond for $1,000 and it has a 2% yield. Now that's the annualized yield. We already know that bonds pay semi-annual interest. So again, you're going to get an interest payment every 6 months. In this case, you're going to get $10 every 6 months for a total of $20 per year in income. $20 per year in income on a $1,000 investment gets you to the 2% yield. So longer term, what this means is you are going to collect $20 of income every year for 10 years. Again, that's your 2% annualized yield. And then you're going to get your $1,000 back at the end of the 10 years in the form of a lump sum payment. It's kind of like having an interest-only loan where interest payments are due every 6 months, and then there's a balloon payment of principal, again, that's the amount borrowed, at the end of the loan. Except in this case, instead of being the borrower, we're the lender. We're acting as the bank. On a high-level basis, a bond's yield is going to be equal to the bond's return over time. Okay, so whatever your annualized yield is, in this case 2% on this example we're using on the U.S. 10-year Treasury, that means you're going to average an average annual return of 2% per year over the course of that 10 years. That's just the way bonds work. It's very difficult to make money in bonds from a capitalization standpoint, right? From trading a bond, buying a bond at a discount and selling at a premium. It can be done, but it's very rare, and it's best left to professionals, okay, money managers, people like that. So, but just understand that if you buy a bond for $1,000 and you, what they call clip the coupons, okay, you're owning that bond for that 10 years in this example of the U.S. 10-year Treasury. You pay $1,000 for the bond, you get $20 of income every year, you get your $1,000 back at the end of the 10 years. Your total return is going to be that $20 every year, right? So you're going to average that 2% per year by owning this bond, okay? The other thing to understand is that bond yields have been trending lower for decades, and let's take a look at that now in the next slide. What we're looking at here is a chart of the U.S. 10-year Treasury yield from January 2nd of 1962 through November 26th of 2019. This chart comes straight from the St. Louis Federal Reserve website. And what we can see here is on the left side of the chart, we started off back in 62 with a yield of about 3.5%. And you can see as we move through the 70s and into the early 80s, where the yield on the 10-year Treasury went up to about 16.5% by 81, 82. And by the way, these vertical gray lines, those are recessions. Okay, so you can see going into the recession of 81.82, the yield on the 10-year Treasury hit about 16.5%. And then we've been in a steady decline from a yield perspective. We've been in a steady decline on the 10-year Treasury bond, the U.S. 10-year Treasury bond, for basically the last 40 years, okay, since the early 80s. And you can see when we look over to the left of the chart, we're at one of the lowest points right now. Okay, as of the production of this video, as of this chart, we're at one of the lowest points ever on the U.S. 10-year Treasury. It is extremely important that you understand that yields have been falling for a long time. And some of the ramifications and the reasons for this are way beyond this particular video. So look for other videos on this over time. But just understand that that's the reality that we're living in, okay? That bond yields have been falling for basically 40 years. And understand from the previous slide that a bond's yield is going to be equal to the bond's annualized return over time. So if bond yields have been falling and bond yields are at the lowest point or one of the lowest points in history, then what we should also understand just by looking at this chart is that the return on a bond is abysmal, okay, abysmal compared to what we have experienced in the past. In other words, bonds are just not a great value right now, guys, okay? So do your own research. I'm not trying to make recommendations one way or the other. I'm trying to educate you. But look at the chart, come to your own conclusions, but the math suggests that it's just not a good value right now. And let's take a look at that, okay? So here again is the example of the U.S. 10-year Treasury bond. It's yielding 2%. Now, what this means at a yield of 2% is that you are paying 50 times annual earnings for the U.S. 10-year Treasury, okay? So you have your annual earnings of $20. You have an investment of $1,000. Now, if this were a stock, and we don't use PE ratios on bonds, but if this were a stock, what this would mean is that we would have a PE ratio of 50, okay? You make a $1,000 investment, you make $20 a year, that is a 2% yield, right? But it also, you reverse that, and what this means is your price to earnings is 50 to 1, okay? You have a PE, a price to earnings ratio of 50. If you want more information about PE ratios, again, go out to my YouTube channel. I have information about that. Now, to put this in perspective, a PE of 50 is over 2.5 times the current S&P 500 PE ratio. Let me repeat that. A PE of 50 is over 2.5 times the current S&P 500 PE ratio. All right, so said another way, is the U.S. 10-year Treasury bond is currently at a yield of 2%. And by the way, I'm going to show you that it's actually worse than that. But at a yield of 2% in this example, okay, we're using round numbers for easy math, just so you get the concept, so you understand how this works. And then as things change over time, you will own this information and you can come to these conclusions. You can run these numbers in your head or on a piece of paper, whatever, but you can do the work yourself once you own this information and how it works. But at a PE of 50, okay, you're paying 2.5 times the value of the S&P 500. So in this example of the U.S. 10-year Treasury at a 2% yield, that Treasury bond is selling for 2.5 times what the S&P 500 is currently trading at. And by the way, it's actually worse than that right now. Now, let's look at some other considerations. With a 2% yield, keep in mind that is taxable income, okay? We're talking about taxable bonds here. The U.S. 10-year Treasury produces taxable income. So that 2% yield is taxable. And also, what about inflation? Okay, inflation is the loss of purchasing power. Okay, that's really what inflation is. As inflation goes up, it means your dollar doesn't go as far. You're losing purchasing power. And the CPI, the Consumer Price Index, that's what the government uses to kind of determine on a broad scale what inflation is. Okay, but the Consumer Price Index has averaged 3.76% annually. That's the average since World War II. We're in December of 2019 here, guys. And so since World War II, the average annual consumer price index inflation rate has been 3.76%. In other words, your dollar is getting 3.76% weaker every year from a purchasing power perspective since World War II. Now, over the last 10 years, the annual inflation, so says the government, has only been 1.77%. Okay, so over the last 10 years, it hasn't been as bad. Okay, but still, your dollar is losing purchasing power over the last 10 years at a rate of 1.77% per year. So if you're making a 2% taxable yield, whatever your tax rate is, right, you have to deduct that from the 2%, and that is, then you end up with your net spendable money. And so you can see here that even if inflation was only 1.77%, you still are maybe at best keeping pace with inflation with a 2% yield. So these low rates of return on bonds these days are really horrendous for conservative savers. The actual yield on the U.S. 10-year Treasury bond is 1.83% as of December 2nd, 2019. And that yield has been as low as 1.459% on September 4th of 2019. If you would like to learn more about what it takes to be a successful investor in today's market environment, I would highly suggest you watch my information-packed Successful Investor webinar, which is out on my YouTube channel. I will also leave a link to this webinar in the description box below this video. The webinar lasts about an hour, and I promise you it will be one of the most important hours you have ever invested in yourself. So what are the next steps? Watch my Successful Investor webinar, watch my other YouTube videos, subscribe to my YouTube channel for ongoing finance and success education. Please give me a thumbs up on this and other videos that you like, leave a comment on my videos, and share my videos and my YouTube channel with your friends, family, and colleagues. And please feel free to connect with me on social media. Thank you so much for being on this video with me. I really appreciate it, and I look forward to seeing you on the next video.